Hit the intro.
New York City transportation has a daily ridership of 3 million. That's a whole lot of moving. Welcome to the elite. And welcome to We Move New York, the podcast. This is the show for the people that move New York. Welcome to We Move New York, the podcast. And here's your host, Q.
What's up, We Move New York family? Back again one more time with another episode. This episode is episode number 9, titled How to Get a Mortgage. This episode I'm going to step away from the transportation theme of the podcast for a moment and talk about mortgages. Why am I going to talk about mortgages? Because recently while working the general pick, the topic of homeownership and mortgages kept coming up, and I was shocked at how many of our colleagues didn't know anything about how to get a mortgage. And quite honestly, people kept coming to me because they know I own homes and been through the mortgage process a couple of times, and I was answering any questions that they had. So I thought it'd be a great idea to share some of the information that I have on the subject. So according to a survey conducted by Zillow in 2019, around 46% of Americans felt uncertain or unprepared about the mortgage process. This show is designed to provide a valuable insight on and practical advice on some of the things you need to know when it comes to getting a mortgage. Buying a home is one of the biggest financial decisions you'll make, and a mortgage is a crucial aspect of the process. In our show, we'll be sharing expert tips and breaking down some things into an easy to understand language. So if you're feeling overwhelmed or unsure about how to navigate the world of mortgages, this podcast episode is for you. So stay tuned and get ready to take your first steps to getting a mortgage. So one of the things that I like to do is not only share information, but I always like to share some of my contacts. And what I'm going to do is I'm going to bring in my mortgage contact. His name Muhammad Ilyas. He's a branch manager with Cross Country Mortgage in Bergenfield, New Jersey, and he's been working in the mortgage industry for 15 plus years. Let me bring Muhammad Ilyas into the show. What's going on, Muhammad?
Hey, Haran, how are you?
Hey, everything's good, man. How's life?
Good. How you been?
I want to just tell my viewers that, you know how everybody has a guy. This is my guy when it comes to mortgages. Like, anytime anyone has a question about mortgages or looking to purchase a house, and hey, you know anyone, I always refer them to Muhammad. And one of the reasons why I always refer them to Muhammad is because when I first met Muhammad, any questions that I had, even though we weren't at the time conducting business, he always answered any question that I had in great detail. I've been through the mortgage process like about including refis, about 12 times. And the other mortgage professionals that I've interacted with, they only seem to want to talk if we was conducting business. As far as Muhammad goes, when I've referred him to other people, I always get a good feedback from, hey, I spoke to Muhammad. This guy knows what he's talking about. He took the time to explain this and that to me. And some things that may seem elementary to someone that's been through the process, again, he has no problem ever answering those questions. So I'm going to put his contact information up here so you can write it down. And after the show, if you have any questions or anything else you want to know that we didn't cover here in the show, you can reach out to Muhammad. And I'm glad, I know he's more than I know that he'll more than be happy to answer whatever questions you have. Am I correct, Muhammad?
Definitely. Thanks, Haran.
So listen, so I like to tell people one of the first steps in getting a mortgage, and we all know, you got to have your credit score, etc. That's the topic for a whole nother show. What is the first step? And I always tell people the first step is a pre-approval letter, right? So
absolutely.
So when someone reaches out to you, what's the first steps when it comes to getting a pre-approval letter to start the mortgage process?
So obviously, when someone reaches out to me, the first thing I want to do is address any questions they have, or, either myths or, whatever they've heard on the street, or what their, cousin told them, or their best friend told them, or their realtor told them. Right. Again, not that is inaccurate, but we want to make sure the information they're going off of is accurate, right? So that's the first thing. The second thing, obviously, is obviously after we answer any questions, we do want to kind of get into that pre-approval process. And usually all the questions they have will be answered throughout the process. Right. So the pre-approval process consists of 3 main objectives. One is obviously look at the credit. Second is income and employment kind of bundled together. And the third is the assets, the down payment money, if we need any kind of money put away for a rainy day, where all that money is. And we just want to make sure before the process starts, all that it's good to go, right? So if we were to break down the credit process first, we pull their credit, not only the score does matter, absolutely, right? Obviously at cross country, we go down to 580, but we'll even case by case go down even lower. So that's a pretty low credit score, right? But obviously the higher the credit score, the better it is for someone as far as get a better interest rate, or we may be more aggressive on the down payment, etc. Right. But as much as the score itself, what we also we call it in the business is we scrub the credit report with the client, because we just want to make sure everything that's in the credit report belongs to the client. So sometimes if they're a junior or senior, sometimes where the senior stuff might be showing up on the junior's credit report, we just want to make sure it's accurate, right? So we go through the credit report, make sure all the credit lines that are active right now is accurate, the balance is accurate, even the monthly payments are accurate, because the next part I'll go over that those minimum payments on those balances that they're paying goes into their debt to income ratio. And I'll go over what that means in a little bit. Right. And then also we want to scrub the credit report to see if there's any judgments under their name that were either maybe old, still reporting. Maybe we also want to make sure if the client had any bankruptcies or foreclosures, because all that does, again, just because they have that doesn't mean they don't get a loan, but there might be some waiting periods that we have to kind of deal with. If they had a bankruptcy or Chapter 7, we might need to wait 2 years before we could do a loan for them. If they had a foreclosure, we might have to wait till 3 years before we could do a loan for them. So we don't, again, case by case, we could do it sooner, but these are just the general kind of like, guidelines we want to stick to. And then we could at least we know what we're dealing with, right? So that's the first main step, the credit. So we look at the credit, we scrub the credit report with the client, make sure everything is accurate. And then we kind of go on to the next step, which is income and employment, right? So when it comes to employment, again, the myth is, I have to be in the same job for 2 years. That's not accurate. So the accurate is they have to have the job history for 2 years. So it could have been different jobs, but as long as we kind of piece it together, show they have 2 years. And even certain scenarios, a lot of scenarios will even use education as part of that 2 year history, right? Like let's say you're a computer guy, you went to school for computers for 4 years, then got a job. We'll use those 4 years part of the 2 year history, so we don't need to wait for them to work for 2 years before we could do a loan for them. Same thing goes for teachers, doctors, lawyers, anything that was the education was geared towards the job, right? So we'll kind of use that history of schooling or certification as part of their 2 year. And then obviously, what do they make, right? That's the key, because more than even credit, what we in the industry we care about is, can they afford the monthly payment? That's what really what matters to us. So as long as, we figure out the income, we see what the income entails, their base salary, their overtime income, we'll use, depending on case by case, how long they've been getting the overtime income for. So the rule of thumb is at least 2 years, right? So as long as they have overtime income or commission income or bonus income, these are the added incomes to the base salary. We'll have to see a 2 year history.
So that would also include a part-time job, correct?
Correct. So that's a great question. So part-time jobs, the way that works is, as long as they have a history of having a part-time job for 2 years, we'll use the part-time job as added income to that client.
Right. So it seems like the key number is 2. And one of the things I like to tell people when they're about to apply for a mortgage is to have 2, 2, 2, and 2. I tell them all the time, the mortgage company is going to ask for 2, 2, 2, and 2. 2 years tax returns, 2 years 2 years tax return, 2 years W-2, 2 months of bank statements, and 2 months of pay stubs, correct?
Yeah, I mean, we don't need 2 months, but throughout the process, we'll always be updating the pay stub just to make sure the income hasn't changed, or maybe the income got better, right? So that's another case. So let's say someone who comes to me and says, "Hey, my income is 40,000, but next month my income is going to go from 40,000 to 50,000, right? So we'll say, hey, okay, we know that income is definitely going to go to 50,000. So and in the process, it's going to take them at least a month and a half to find a house and get into the loan process. We'll use the 50,000 to qualify them. So it's
Right.
not like they have to have had making that 50,000 for years. It just, as long as it's a guaranteed their salary's going up, we'll use the 50,000 right away.
Right.
You know,
proof that's going to be continual.
exactly. You know, and then so that's where the income process comes in. And then, there's other incomes that we'll use for different situations. We'll use Social Security income. We'll use disability as long as it's what do you call it? Lifetime disability income, not temporary, right? We'll use say it again.
What about child support?
Of course, if child support, we'll use child support income. We'll use alimony income. Now, the child support income we'll use as long as the child support income will continue from at least 3 more years.
Okay.
Right. Right. That's very important. So we'll ask for the child's birth certificate, kind of like stuff like that, to kind of prove that situation. Right. And then we'll use alimony income. We'll use, obviously military income. So there's a lot of other incomes that we could do it now. And, now when we're talking about the income situation, we're talking about 95%, let's just say, is just W-2s, like you mentioned before, pay stubs, that kind of income. Now, there's other programs that, the way the industry's going now, that falls under a whole different category, and it'll be another whole podcast just based off of that we could kind of talk about. But we're just talking about the norm of the kind of the incomes that we use.
Mortgage, straight 9 to 5. You're not talking about self-employed, commercial.
Exactly.
Properties. You're just talking about maybe single family homes right now.
Exactly. So and then the last big section that we focus on is the assets. So the assets really is for the down payment, right? The assets also sometimes used for what we call as reserves, meaning we want to, if whatever the mortgage payment is, if we could show to the investor that, hey, the client has 6 months of money put away for a rainy day, kind of a reserve fund, either through 401k or, just savings and checking, or some kind of CDs, annuities, stuff like that. To our eyes, they become a stronger client, or we could be more aggressive on that client.
Yeah, because no one wants to give you the money to purchase a home, and then you can't make the payment after you close a month later. So they want to have some money.
Also, the way we're looking at it, I mean, as long as they have their job, they're good. But God forbid something did happen, at least they have kind of like that reserve to kind of carry them through that, maybe a new job, looking for a new job, whatever it is, right? So if we get a client, so we are able to be a little bit more aggressive, or maybe if they lack a certain area, either the credit score or the down payment or something like that, we could be a little bit more aggressive and say, hey, look, yes, they're a 580 credit score, but look, they got 12 months of mortgage payments put away in their savings and checking. So, to us, they become a much more solid of a borrower in that sense.
Right. So basically, it's like on a case by case basis. Even if it isn't superior, it's still possible to obtain a mortgage.
Absolutely. I mean, a lot of our mortgages are, we call it, there's 2 types of underwriting. There's the automated underwriting, right? And then there's the manual underwriting. The manual underwriting is more like, hey, I lack this, but I'm strong here. I'm strong here. I'm strong here. Let's see if we could fit you into that manual type of underwriting loan scenario. And we do a lot of those too. If they go, they fall somewhere kind of like outside the box of the norm, let's just call it,
What are some I'm sorry.
So I just want to finish up the bank statements for the down payment. So what we're always looking for, and the way you said 2 months, is we're always looking for 60-day window of where the money is for the down payment they're going to use. And, we'll also go over the closing costs and the process also, where the money's going to come from. That money can come from a few places, right? So it could come from your 401k. It could come from, obviously, savings and checking, the normal kind of stuff. But, the down payment and the closing costs can also come from a gift from a family member.
Right.
Right. Even the employer. Some employment programs have some down payment kind of assistance through their employers. They'll kind of do that. Or Certain times, like New Jersey also, I mean, every state has it, every county has it. They have down payment assistance programs.
Right.
Again, those are different qualifications, but as long as, hey, you qualify for the 95% of the loan from the lender, or the 96.5% of the loan from the lender, yes, then they'll say, okay, and then these are our qualifications. As long as our qualifications match the down payment assistance, then we're able to kind of get that down payment assistance also to help qualify for the mortgage.
Awesome.
Yeah.
What are some of the common mistakes that first-time home buyers make when applying for a mortgage?
The most common mistake is they don't apply. What they do is they go and look at houses. Again, there's nothing wrong with looking at houses, but if you don't know if you qualify for the house that you're walking through and you're falling in love with it, that's kind of the most disservice you could do to yourself. Because
Right.
now you loved it, your family loves it, then you come to a mortgage professional and then they say, oh, sorry, you don't qualify for that much. And then they're bummed out. And then even after that, the whole process, they're always going to be comparing that house that they loved it to any other house that
Yeah.
they're now walking through, right? So that's the most disservice you could do to yourself or to your loved ones. But after they apply for it, what they do is they kind of like either they'll after they're pre-approved, they might sign up, go get a car, or spend the money that was in the savings that was allocated for the down payment or the reserves. Certain scenarios, they'll spend that money, and now we have to either recoup that money some other way or wait for them to recoup that money. Those are the things. Now, obviously, that's time will fix that. But the biggest one I've seen is where they'll go get new credit.
Right.
Either get a more expensive car, or a lot of my clients, they'll because we hammer that in their heads, like, hey, again, we're not gonna stop them from living life, right? We can't.
Right.
If them finding a house takes a year, we can't tell them not go get a car, but we could talk about it, right? Say, hey, the last car you had was $300. Okay, your lease is up. What are you gonna go get? Are you gonna get something around 300? Is it gonna be cheaper? Is it gonna be more? If it's more, we want to kind of use that payment and rerun the numbers to make sure they're still qualified for what they're looking for.
Right. You can purchase your way out of a mortgage.
Yeah. Yep. Absolutely.
Right.
Absolutely.
I like to tell people not to move too much money around in their bank accounts.
Yes.
That becomes a problem also. Cause I know, in addition to that, I know it was one of the hangups I had once was I was sending Cash App a lot to my daughter, and it was like, okay, who's this payment going to? I'm like, it's just $30. Yeah, but it's a lot of $30 payments. Like, so I try to tell people, like, don't move around a lot of money, and be careful with your Venmo and Cash App that you're sending.
Absolutely, because money coming in is, as we want to know where that money's coming in from,
and going out.
Right, going out too, because if it's a debt that you're consistently paying, the reason you got questioned that is because they figured it was an actual debt that you're actually paying every month from your bank account. So then they want to know, oh, do we have to add that to your debt to income ratio?
Correct.
Right.
So would it be wise to set some money aside that you're going to use like everyday transactions into another bank account?
Yeah, I have a lot of clients. What they do is they'll, as soon as they know they're going to buy a home, they'll open up another checking account or a savings account and have that account be very clean, where only money that'll go into that account is part of their paychecks that they're just having it direct deposited into that account, and that's it.
Yeah, that's one of the things I learned to do, and I tell people, like, 2 months out, if you know you're ready to start going look for a mortgage, start setting up your financials a certain way. So this way, it's when you have less questions to answer, the process is so much smoother.
Oh, absolutely.
And also, like, a lot of times, like you said, it's a 60-day window, but sometimes that 60-day expires and you have to resubmit the papers again.
Yes.
And like, a lot of times people tell me, I can't believe they want these papers again. I said, listen, you're getting a loan for $400,000. All you gotta do is submit some paperwork, and you're complaining, But when you have less paperwork to submit and everything is set up, it makes the process easier. Just when you just shoot it off in a file and get it updated, and everything keeps rocking and rolling.
Absolutely.
And mortgage broker is not chasing you down to get the information. Think about think about this: if a mortgage broker has to chase you down to get information to give you a loan, to me, how smoothly are you going to be with the payments? If I got to chase you down for paperwork,
Yeah, good point.
down for these payments, you know what I'm saying? So
Yeah.
it's not a good look when your mortgage broker is like, hey, I've been waiting a week for you to send me your last pay stub. You still haven't sent the pay stub. So try to be on time with the paperwork and anything that the mortgage guy is asking you to submit.
Right. And then just so you know, even from the mortgage side, we're always in the mindset of, we don't want to give too much information to anyone either, right? Like meaning to the underwriter and something like that. So we're always, we're also asking for the minimal paperwork also. So, but obviously, like you said, documents expire. So where intention is, if I pre-approve someone, let's say today, our intention is them to find a house as soon as possible. But unfortunately, that's not how the market or their liking of the homes that they see works out. So sometimes some people who are, adamant to find a house right away, it takes them 6 months sometimes, right? So some of those documents, even though nothing's changed, their pay scale is still the same, that what's in the money in the bank is still the same, but we still need those statements updated. So it's not, because there's a time sensitive material, so that's the only reason. We're not looking to make a client go through, jump through hoops, stuff like that either. But we're just always trying to update the stuff, in a meaningful way
to get a mortgage.
Yeah.
So how can borrowers improve their chances of getting approved for a mortgage?
I mean, the key is what I would say is this, right? I would, if they have even an idea, let's say, next year I'm going to buy a house, or even, end of this year, whatever the timeline is, I would call a mortgage professional and get pre-approved, right? Even though, and you could tell them, like, I have people I pre-approve. I have a client we just did on Friday. He said, hey, I'm not buying a home till next February, but he wanted to get pre-approved, right? Which is fine for me. I have no problem because that, for me, now we have time. If there is something lacking, either credit or the money in the bank or whatever it is, we could kind of like talk about it and come up with a game plan how we're going to fix that. So when come next February, he's ready to go. So the process really, it does help. And then there's clients who come to me right and say, hey, I'm looking to buy right away, but whatever the reason, maybe they had a bankruptcy or a foreclosure in the past that they have to wait. But now at least they know, okay, the earliest I could buy a house would be next March. But now at least they know, and then we could actually work on the rest of the stuff while we're waiting till March comes around. Right. I think, sorry, go ahead.
How long is a pre-approval letter good for?
So that's a good question. That's the question everyone asks me, obviously, right? Because so like we spoke about, documents expire, right? So updating documents is not big of a deal because 95% of people, nothing is really changing when if we were to update a document, right? If they're 50,000 making a year, they're 50,000. That's not changing, or whatever it was in the bank. So the only thing that kind of expires officially I would say is a credit report. A credit report is good for 120 days, right? So we want to, whatever credit report we pull for the client, we have to use that credit report and we have to close with that credit report in 120 days.
Okay.
So I like to, even though the credit report is good for 120 days, technically we could say that a pre-approval is good for 120 days. But I like to, even though it's good for 100, I always date my pre-approvals at least 60 days.
Okay.
Say it's good for 60 days. This way, because you also you got to understand what the pre-approval letter is, right? That's us kind of telling the seller, right? Hey, this is my, it goes with their offer, the pre-approval letter. I want that pre-approval letter to be very professional, but also the dates and everything on there. I like the address of the property that they're actually making an offer on, not just say TBD and it's dated in November when they're making an offer in January, right? Because I want them to see the seller side who they're making the offer to see like, hey, this pre-approval is from yesterday. That means I looked at everything yesterday. Even though I've been talking to the client for the last 6 months, I always want to make that pre-approval very fresh, because that I think it does mean something, compared to when they're going through the offers, especially now with 10, 15 offers on these houses. I think they look at certain things like that.
Right. That definitely does make a difference. I know had a pre-approval from you. I was surprised when you asked me what's the address of the property. No one has ever asked me that before. And
Yeah.
I think it did make a difference because it looks more professional when you submit an offer.
Yeah, because I mean that's the only thing they know about you, right? I mean, they might have seen you and whatever, but regardless, but that piece of paper is the only thing they kind of know about your situation. So I want that letter to be as professional as possible and up to date and very clear and precise what we're doing for the client, our client, and we're kind of putting that to the side of the listing agent and the seller to kind of review for themselves. Based off of that letter, your situation.
So how does credit impact the mortgage application process, and what can borrowers do to improve their score?
Gotcha. So credit it impacts in many ways, as far as, like we've said, interest rates, right? So the better the credit score, let's say, the better whatever the best interest rate, the better the credit score, or if you have an excellent credit score, you're going to get that whatever the best interest rate at that time is, compared to someone who has a weaker credit score.
Right.
Credit also allows lenders to be more aggressive, meaning someone with a very good credit score, great credit score, the debt to income ratio, that is the mortgage payment compared to your plus the debts on your credit report compared to your income. That percentage is called a debt to income ratio.
Right.
That ratio, we could go way higher on someone who has excellent credit versus someone who doesn't have as good credit, right? Because we're saying, hey, they're very responsible on their credit, so we're making a decision based off of credit. There's really nothing plus income. There's really nothing else we're going to use to make that decision, right? It's going to be credit and income. So we're a little bit more aggressive on someone who has excellent credit. And credit will also use credit for, someone who on certain programs where they might need to put 10% down. If they have weaker credit, where if they have excellent credit, will make them only put 5% down or 3.5% down. Right. Depending on that situation. So credit does matter, right? But also what matters is what's on the credit report matters too. So I think that's the same kind of question you asked me, what can someone do to make their credit better? So what they could do is, obviously, the only way to make your credit better is with credit.
Right.
Right. It's kind of like a catch-22, because it's like, wait a minute, how, the same thing that's going to kind of make your credit lower is the same thing that's going to make your credit go higher.
Right.
So meaning, like, let's say you have 3 credit cards and all 3 credit cards are maxed out. That's going to kind of lower your credit.
Right.
But now if those 3 credit cards, your balances are only 10% of what's allowed, your credit score is going to be much higher than someone who's all maxed out. Now, same scenario, the person who is maxed out gets, God forbid, gets a late accidentally, their credit score is going to get hit way harder than someone who only has the same 3 credit cards, but the balances are very low and has a late accidentally has a late. They're not going to get hit hard as that first person.
Right. So you would recommend paying down some of your debt before applying for a mortgage?
Oh yeah. I mean, if that's, again, it's a little bit tough because now that money, we got to look at that money and say, and we'll run these rapid rescore scenarios for clients. Say, hey, you're right at that cusp. Let's say I pull a credit and their middle score is a 619, and I know I could get them a way better loan for them by getting them to let's say a 640, right?
Right. So
I'll run the rapid rescore and say, hey, if you pay that Bank of America credit card down another $1,000, let's say, right, which is it's a lot of money, about $1,000, your score will go from 619 to 650, let's just say. We'll go through those scenarios because, again, our goal is not just do a loan. We want to put the best loan possible for the client, which entails a better loan for the lender, right? Sorry, go ahead.
So you're able to look at someone's credit score, right?
Yes.
Analyze it, and
Yes.
in certain scenarios is like, okay, so if we went forward like here, this is the type of loan you'd be looking at. However, if you did some things over here in this area, this is the type of loan you could be looking at.
Absolutely. And it matters. And it could even matter in the type of loan where, conventional versus FHA, right? Where they might qualify for conventional or they'll only might qualify for FHA, those are all credit score driven as well.
Right.
There's other things that someone could do to improve their credit. Obviously, go get more trade lines, right? Because if their trade lines are weak, stuff like that. But, if someone, people always come to me and say, oh man, I got a car loan. Does that mean I'm not going to get a loan or my credit lower? No, not necessarily. As long as you're paying that car loan on time, it's not going to hurt your credit. Now, but it's not going to, your credit score is not going to shoot up just because you paid your car loan on time, right? Same thing goes to, because those are all installment loans, meaning you're told what to do for the first payment and you're told what to do for the last payment. Where you really control your credit score to get it higher, or if it hurts more, is those unsecured credit card debt, right? Because now instead of you paying just the minimum, if you could show the credit bureaus that you're paying chunks of it off, they're going to say, oh, wow, this person's really like chunking their credit cards out. And so that person's going to have a way higher score than someone who's just renting out that money by paying the minimum credit score.
Right. So with you and your company, right, what is the application process like that? Is it pen and paper? Someone got to come to the office, or can they go online and fill out an application? Right.
So good question. So it's really whatever is comfortable for the client. So we're fully automated, and we have app. You go in, you click on it, you fill out the application. You could, upload your documents right then and there. And next, in minutes, I'll have it and I could pre-approve you right then and there. Right. But we want to be obviously, or we could do the application right over the phone. I would take the application right over the phone for a client and we could do it that way. And if someone wants to come to our office to do it in person, it's really the comfort factor, whatever the client's comfortable doing. Not everyone wants to fill out the application themselves, but we're not trying to tell them not to do it. Whatever they're comfortable, really.
Right. So the first step would be obviously to contact you, fill out a mortgage application and get a pre-approval letter, or is the application for the mortgage, just to get a better understanding of when someone comes to your website, what are the information that they're filling out is for?
Well, the application is for the pre-approval process, which in turn will turn into the loan process, part of the loan process.
Okay, so going through the steps here. I come to your website, I fill out the necessary information, I get a pre-approval letter. With that, then I could go see a house. I see a house that I like, I want to make an offer. What's the next step?
So when you're making the offer, what I'll do, what I doesn't mean just specific what I do. I'll change again. Pre-approval letter is kind of like a TBD letter we give the client. So this will kind of get them in the back seat of the realtor's car to kind of go see those houses, because a lot of realtors, rightfully so, they want to see a pre-approval letter before they could show houses. And I think that's a smart move on everyone's part, right?
You may want.
So then they go see the house, and now the realtor will call me and say, "Hey, Mo, we're going to make an offer on Mr. Jones's Jones. It's 123 ABC Street. Can I get a pre-approval letter? Updating it to the 400 offer. Obviously I double check, make sure it still qualifies for the 400 for that house, because one thing we didn't speak about, this is very important, why I like to know the address of each pre-approval is the property taxes is a big thing, especially New Jersey, New York, Connecticut, all these the states we live around, So just because I give a pre-approval letter for 400, you also got to make sure what the taxes on that property is, right? Because one house that's 400 on one block could, in one town, is just because that house is 400, the taxes on that, let's say, is 8,000. In another town, that same exact house that's going for 400 might be the taxes are 12,000, right? But they might not qualify with 12,000 in taxes. So that's another thing on my pre-approval, even though the taxes are not on it, on the body of the email that goes to the realtor for the first pre-approval, I always say assumption, taxes max 8,000. So this way the realtor now knows, hey, I gotta make sure I'm looking at a house is not, in that ballpark, because if not, it's not going to qualify, right? So now after they want to make an offer, again, the reason I like putting the address is, obviously it looks professional, but also now I know what I look up the property, make sure the taxes are in line with what we pre-approved the client for in the beginning. And then we make sure it's good to go. We type up the new pre-approval, we send it to the realtor, they make the offer. And obviously the offer gets reviewed, it gets accepted. Then now we get back a fully signed contract.
Right. So with the contract, while you're in contract, again, like you said, you advise don't make any huge purchases, don't move any money in or out of your account if that's unnecessary. Also, so in that interim, while a person is in contract, the deal, so to speak, is going through underwriting. About how long does that take?
The underwriting process, though, the way that works is after contract, it goes into a process called attorney review, right? Attorney review takes about 3 days. After attorney review, usually, this is in New Jersey. New York, the home inspection gets done first, but in New Jersey, the home inspection gets done after the attorney review, right? So after attorney review, then after that, then we process the file, and then we send out the appraiser. The appraiser goes, he or she goes, appraises the home, sends back the report. That report, along with the income documents and everything, goes to underwriting. The underwriting right now for us is taking about 48 hours, let's say.
Oh.
Right. So then in underwriting, the appraisal gets reviewed, the documents get reviewed and everything, and then the underwriter issues what they call a commitment. Right. That commitment letter goes to all parties, because that's a very important part of the mortgage process, the commitment letter. Right. Now, from that commitment letter, still will have some kind of trailing documents, let's say. Maybe the initial down payment wasn't put in yet, so they'll need the proof of that. Maybe we need a one or two more pay stubs or bank statements showing the initial deposit going out, stuff like that, and then we'll get that proof, and then the file will go back to underwriting for a final underwrite for a clear to close.
Okay.
So that process usually takes, again, this is the mortgage process is not technically all being held up because of the lender, right? Because title companies, we're waiting on title companies to run title on the home. We're waiting the appraiser to do the appraisal, and those all have delays either because of, just time and appointments and stuff like that. So I would say usually we're closing our loan from start to finish in about 21 days, average.
Pretty fast. Normally,
Yeah.
it's like 45 days, but 21 days is really fast.
Yeah, we're doing it real fast. Again, and not all loans need to be that fast, right? Because sometimes the seller needs 60 days to move out of the home. It all depends, right? So if it's like, hey, the home is vacant, no one else is going to slow the process down. There's no tenants going to hold the appraiser from appraising the home. Title is clean, nothing crazy on title that needs any attention from the seller side to clean it up. The process could be really simple. Again, as long as all the due diligence was done ahead of time in the pre-approval process.
Right. So speaking of tenants, how different is the process of obtaining a mortgage from when it comes to buying a single family home as opposed to buying a multifamily home? Is the process the same?
The process is the same. The only difference is from the pre-approval side of it or approving side of it, we will be using the rent for the downstairs, the upstairs unit that our client is not occupying. So we're going to have added income to help qualify the client on that home.
Right. So, for example, let's say someone's initially looking for a single family home and they get approved for, let's say, $350,000 loan. But then they switch and say, hey, something, I'm looking for a a 3-family home, will they be pre-approved for a larger loan?
It can, yes. So the quick answer is yes, but just always got to remember a single family home, the taxes, what we spoke about, the property taxes
Right.
is going to be, 99% of the time going to be way higher than the single family home, right? So we're going to keep that in mind. Now, so on that side, absolutely, we're going to have more income. We're going to be able to qualify them for more, but there are certain situations, especially you mentioned 3 and 4 family homes, where you have to have reserves,
Right.
where money put away for a rainy day when you're purchasing those type of homes, right? So now if we did a single family home and we had exactly the down payment and the closing cost, and we didn't have another dollar for anything allocated, now we got to be careful. Now if we're switching to a 3 family home, we got to figure out, again, can it be done? Absolutely. We do it all. It happens all the time, and we do it all the time. But we have to have a conversation on how we're going to, overcome that other situation. Maybe there's a 401k that we didn't know about, or, other means that we have to kind of discuss how to make that happen.
Right. So switching back to closing, what are some of the closing costs that borrowers should be aware of when applying for a mortgage? Because a lot of times when people talk about purchasing a home, there's a lot of talk about down payment.
Right.
But you rarely hear anyone, because the down payment is easy to calculate as a percentage of the purchase price, but the closing costs, I know me, when I look at my HUD statements and you see all these line items, like what is,
Right.
where are these fees coming from? So it varies, and it's really hard to say how much your closing costs will be. So like, what are some of the things that when
Right.
you go to closing?
Right. So the closing costs, obviously, everyone holds the lender responsible for, but I would say a good 80% of closing costs is not going to the lender, right? So the first closing cost, this is not going to be on your HUD statement, will probably be the home inspection, right? So that'll be a cost that you're going to pay even before, right after attorney review, right?
Mhm.
After the home inspection, as long as everything went well, the next closing cost that'll come up would be your appraisal fee. So that's the only closing cost that you're, the home inspection, and that probably the only 2 closing costs you're kind of paying ahead of time before the closing, the actual day of the closing. The rest of the closing costs will probably be collected on the day of the closing. So those closing costs would be a attorney fee. The attorney is going to order title, so the title company will have their fees, and then the mortgage company will have a processing fee or underwriting fee, depending on what state the loan is being done in. There's certain fees that they could charge and cannot charge. And then also now for your property taxes and your home insurance, you're going to purchase the home insurance ahead of time, 1 year ahead. Then the following year, they're going to collect it throughout the year. And then when the bill is due, they'll pay it on behalf of you, the escrow company.
Escrow,
right? Because they're going to escrow your taxes and they're going to escrow your insurance.
Right.
And then now also so that's a little bit. So let's say your taxes are $12,000 a year and they escrow 5 months, that's just closing costs. Escrow is $5,000 just on the tax line item.
Right.
Right. So it's a lot of money. Right. But again, that's your money. So if you were to, not this is going to happen, but if you were to sell your house the next day, that 5,000 will come to you technically because that's in the escrow account. Right. So escrow in New Jersey, taxes get paid every 3 months. So every 3 months, that account's going to go up, going to go down, going to go up, so it just keeps going.
Right.
The home insurance will get paid every year. Right. So the first year you pay up front, then the next year, the escrow company will pay that money. What's from the escrow account.
Right. And that's one of the misleading things that you see on a lot of websites. And I'm not going to name the website in particular, but like if you're surfing the internet and you see the home that says estimated payment, and it doesn't it'll just show principal, it'll show the principal and interest, but it won't include the insurance and taxes. Because your mortgage consists of the 4 components: the principal, interest, mortgage. I'm sorry, principal, interest, taxes, and insurance. And that can vary. But are there ways, like, so say the closing costs say 10 grand and you don't have the 10 grand to close. Are there ways to roll the closing costs into your mortgage?
Yeah, great question. Yeah. So one way you could do is it's called seller concession, right? And this is an actual line item where, let's say You're purchasing a home for 400, but let's say the home is worth well over 400, and you could actually say, ask the seller to give you back 10,000, and let's say you're going to purchase a home for 410, and
Right.
you could get the 10,000 rolled into your 10,000 worth of closing costs rolled into the loan.
Right. That's very like
Huge.
me.
Yeah.
Me personally. I gotta tell people, cash is king. I like to have as little money in a house as possible. If I can get all or some of my closing costs rolled into my mortgage, I'll do it. Because think about it. Sometimes, say you buy a house and now you don't got two nickels to rub together, but you want to buy drapes, a new living room set, and a
Yeah.
sofa, and you have no money. But if you could roll that into your mortgage, so you have, like you said, still have reserves and still have some money to live on, and
Absolutely.
not have to eat
Absolutely.
ramen noodles
Yeah.
for
Yeah.
for a
No.
few
Yeah.
months.
And,
Yeah,
look at it also this way. Even if you had money, right? Or you want, what's better to go get 22% interest credit cards from furniture stores, or use the money in the bank that you just created from doing the seller concession and buy the furniture cash,
absolutely,
right? So
absolutely.
it just makes even it just makes more sense. Again, those are also, the seller has to be willing to do it,
Right.
obviously, right?
And
But it's happening again. I mean, the last 2 years when it was tougher to get the seller concession, but
right.
now we see more and more sellers are kind of open to that too. So which is great. It helps our clients out a lot too. You know.
What states are you available to make do deals in?
So me personally, I'm licensed in New Jersey, but
Mhm.
my group is licensed in New York, Connecticut, PA, Florida, and New York. And my company Cross Country is licensed in all 50 states.
Oh, so you can handle a client for any of the 50 states, pretty much.
Yes,
If not
yes,
you, you could pass them on to someone else.
exactly. Like we have a national, office that out of Ohio that handles all those too.
Just have one final question. What advice would you give to someone who is considering applying for a mortgage for the first time?
I would just call a mortgage professional and just have a conversation.
Now, I'm telling them call you.
Of course, thanks. And then kind of like have an idea what we're gonna how we're gonna do it, who's gonna be on the loan, what if there's any concerns about that, there any situation. Maybe we have to wait, right? If there's a certain scenario, or if there isn't, say let's take a look at it. Let's set up the file, and let's go over this scenario and see what's going on. Maybe a lot of people come to me and say, "Oh, I'm not ready yet." I'm not saying, "What are you not ready because?" Because is it because you're just not ready, or you don't think you're ready on paper? They're like, "Oh, I don't think But sometimes they'll be surprised. They'll be like, "Hey, you're approved," and then so but there's no way to really tell until we kind of set everything up and we analyze everything and we go over everything and make sure, because everyone, you know, because the way we calculate income sometimes is a little different than how people calculate their income, right? Because we go off their gross earnings,
Right.
whereas a client goes off what they brought home,
Correct.
right? So it's a little different. So we're actually using, in some cases 30-40% more in income for certain
Right.
clients, depending on, how they're writing off their paychecks and stuff.
Right. Because I know one of the things when I talk to people about home ownership, and they say I don't have enough money. And my question is, how much money do you think you need to have? And they'll say something like 60, 70,000, and I'm like,
Right.
you could buy a house
Right.
way less than that. For
Yeah.
instance, like if you go on FHA on a $300,000 house, it's like 10,500 for
Yeah.
the down
Exactly.
payment. And
And yeah, there's a lot of myths about that. Even one big myth, you just said FHA. Another myth is like if you used FHA, and let's say you sold a house that you had FHA, and now you don't own a house, they feel that, oh, you can't use another FHA loan. That's not true. You could have another FHA loan. So there's a lot of myths out there. Again, either bad stuff, bad websites, or just people just talking to a family friend or someone who just not that they're giving bad information. They just that's what
yeah,
they believe in, but
right,
it's wrong. You
right.
know.
So, Mohammed, thanks for taking time out of your busy schedule to come
Thank
on
you,
the
Haran.
podcast and talk about mortgages. If you have any questions that or anything that we discussed today was not clear, feel free to reach out to Muhammad. His number's been scrolling across the screen the entirety of this podcast. Give him a call. He's one of the best mortgage brokers that I've ever dealt with, and I will continue to use him going forward and referring family and friends. And Muhammad, again, thanks for coming on.
Thank you, Ron. And whenever you need to be coming on this again, let me know.
Okay, thank you. All right.
Thank you, Ron. Bye.
You've been listening to We Move New York, the podcast. New York City Transportation has a daily ridership of 3 million. And we're the ones that are moving those butts. This is the show for the people that move New York. We hope you enjoyed the show. We know we had fun, and we'll be back soon. But in the meantime, hook up with us on Facebook, Instagram, and YouTube at We Move New York, and hit the website at WeMoveNewYork.com. Until next time, keep on moving.